Okay, good morning, ladies and gentlemen. Good morning. Thank you for joining us, and you are very welcome to the joint Wright Hassall and Wareing Company live webinar entitled Property Investment Sales and How to Do Them in 3 Weeks. My name is David Slade, and I'm a commercial real estate partner here at Wright Hassall, specializing particularly in commercial property investment sales and purchases and investment property management. And the scenario we're addressing in this talk is the familiar one of how to react when receiving heads of terms for the sale of an investment property that state something like, the buyer will exchange contracts within X weeks of receipt of a full package of papers from the seller's solicitors. The figure X in that sentence I find often being 3 weeks, sometimes more, rarely less, but quite often 3. And I get asked by buyer clients whether 3 weeks to exchange is feasible. And the answer I usually give is, well, it's very tight, it's doable, but I'm not sure if we'll have all of our searches back in time, but we'll see what we can do, something like that. Now, a timetable like that is something we do take seriously. To an extent, there might be an element of a tight timescale like that being imposed to focus minds, but as a buyer's solicitor, I need to be aware of the fact that the 3-week timescale might be regarded as some sort of exclusivity. So my buyer client might be the one the seller is going with, as my client is a cash purchaser, but there might be a higher bidder waiting in the wings who could be using those 3 weeks to finalize its mortgage finance. So the seller might be prepared to pull the papers from us once those 3 weeks are up at the drop of a hat. And there could be many other commercial reasons why the tight timescale has been imposed. Also, my client as buyer will have negotiated the price, possibly on the expectation that the rental income will start coming in 3 weeks' time, not in 4 weeks' time, not in 6 weeks' time, or any longer period. So it's a timescale we need to take seriously. But it is a very, very tight timescale for an investment purchase, which is never an altogether straightforward transaction. So what we are addressing today is how these transactions can go through to exchange in a 3-week period to give our clients the turnaround they're looking for, and how our clients and their other advisors can help us to do that. And you probably won't be surprised to learn that it's all about the preparation beforehand, the readying the asset for a quick sale, as well as all about a bit of good time management within the transaction itself. Now, we'll be speaking for about 45 to 50 minutes, I think. I will speak from a seller's perspective. Then my colleague Anna Power, a senior associate in the commercial real estate department, will talk from a buyer's perspective. Anna will then hand over to Jennie Newton, partner at Wright Hassall, who will give some advice from a property tax perspective. And we'll end our presentation with Bill Wareing, Director at Leamington Commercial Surveyors Wareing Company, who will give us a surveyor's perspective. Just 2 housekeeping points. First of all, this webinar is being filmed, so it will be available shortly for viewing on the Wright Hassall website if there's anything you wish to revisit. And secondly, we'll take any questions at the end, but not during the speakers, please, so that we can maintain some pace and momentum. Please just pop any questions in the Q&A box on Zoom. That's the Q&A box, not the chat box. And I'll review once I've finished my section and field any questions at the end. So let us begin. And heads of terms that require exchange of contracts within X number of weeks normally say quite fairly that the timescale starts running upon receipt by the buyer's solicitors of a full package of papers from the seller's solicitors. Now, what does the full package of papers mean? Now, this is what I think it should mean if I was a buyer's solicitor. It should certainly mean draft contract, title, up-to-date land registry official copies, title plan, and copies of all title documents referred to on the register. Copies of all the tenancy documents, the leases, any licenses to assign, underlet or alter, rent review memoranda, deeds of variation, anything supplemental to the leases. Replies to commercial property standard inquiries, general CPSE 1 replies and tenancy specific CPSE 2 replies answered for each tenancy. These should be put together by the seller and its solicitors before heads of terms are agreed. On so many purchases I deal with, these aren't supplied until at least about a fortnight in. Now, it's totally fair in that circumstance for the buyer to say his 3 weeks hasn't started running until those replies are received. So getting those replies in at the outset is important. Copies of all documents revealed by the reply should be part of the initial package. Now, this would mean most notably the option to tax documents, which Jenny will speak about later. The EPC and associated recommendation report, it's a legal requirement to have a valid EPC when a building is sold. An asbestos report, if the property was built before asbestos became illegal in 1999. There are statutory duties under the control of asbestos regulations to consider the presence of asbestos in all commercial properties, and if asbestos is present, to prepare a written plan for the management of asbestos. Now, those duties are usually discharged by the obtaining of an asbestos report or survey for the property. The excuse I find often given on a single let investment sale by a seller where the asbestos report is lacking is that that will be the tenant's responsibility. But it's perfectly reasonable, in my view, for a buyer to know whether or not an investment he is buying contains asbestos, and if so, what measures are recommended to manage that. So in a single let situation, the seller should therefore try and procure the asbestos report from the tenant beforehand, and he doesn't really have to give the fact that there is an impending freehold sale as the reason for asking for that. I also think that every planning permission and ideally every building regulations consent issued in relation to the property should be part of the initial package. The buyer should be given all of those consents to be able to ascertain whether the property has planning consent for the actual use, whether there are any operational conditions in the planning consent that might affect value, and whether there are any alterations that the tenant has done that are not authorized by a planning consent. Now, how do you ascertain that full planning history? Well, it can only actually be done by a local search against the property. And it's actually my view that the undertaking by the seller of a full set of searches prior to agreement on the heads of terms, in other words, while the seller is marketing the property, is actually a very prudent course of action. It's done as a matter of practice on auction sales. So for the same reason, it's a sensible piece of work here to ensure that your private investment sale is concluded within a similar timescale. We've seen some horror stories recently with some local authorities saying they won't be able to procure local search results until significantly into this autumn on transactions we're dealing with now. So undertaking the local and other searches at the outset as seller and presenting them as a package to the buyer is a good tactic from a timing point of view. You need to be careful not to get them too early, as banks will generally not accept them if more than 6 months, sometimes 3 months old, but provided you're not out of those windows, it's very sound practice, I think. Just going back to the official copies of the title to your investment, it's very important as seller that you audit the title as soon as you start contemplating selling. There are two particular things on titles which hold up investment sales. The first is entries on the title in the proprietorship register, which reveal that third-party consents are needed to be produced to the land registry before a buyer can be registered as proprietor of the title following purchase. And the most obvious consent is bank consent from a mortgagee on the title. Now, in most circumstances, the seller will know about that mortgage and will be arranging with the bank to discharge the mortgage out of the sale proceeds. It's surprising, however, how many mortgages we still see on property titles where the underlying loan was sometimes discharged many years ago. It's sensible practice, therefore, to check there are no unexpected mortgages on your title before the sale, as they will need to be expressly released by a land registry form DS1. So in that event, you'll need to find someone friendly at the bank to help you procure that written release from the bank securities department. That might not be straightforward if you've not dealt with that bank for many years. Possibly a more common issue is a restriction which appears on the proprietorship register of the title, where consent to a disposition is needed from a third party who is not a mortgagee. Now, restrictions are frequently there as a technical device to ensure that positive covenants to do something, such as an obligation to pay a freehold estate service charge to some third party, to ensure that positive covenants run with the land, which would otherwise not be automatic at law, as it is for restrictive covenants not to do something. If the restriction was dealt with in a user-friendly way at the time it was put in place, compliance with the restriction can be self-certified by your solicitors as seller or by the buyer's solicitors. However, restriction structures are often dealt with too lazily by solicitors, or solicitors too easily concede restrictions to their detriment in front of stubborn third parties, resulting in onerous restrictions becoming warts on the title, with the effect that you may find you'll actually need the consent of the third party before the restriction is released. In other words, you'd have to come cap in hand to a third party to get your property sold. That could have a considerable impact on your desired timing for the sale. It's important issues like that are checked and resolved before the wheels start moving on the legals on your sale. The other title encumbrances that should be audited and tidied up beforehand are expired leases that might still be registered on the title. Buyer solicitors don't like those. Take a situation where you're buying, say, a 4-unit investment, say units 1, 2, and 4 are let, but there is a particular attraction in finding a good quality tenant in the near future for the vacant unit 3. However, still registered against the title is the former lease of Unit 3, which was terminated by a surrender, perhaps, or maybe by a tenant break. No one tidied up the title when the lease ended. The buyer will want that formal lease off the title to remove any concerns that the former tenant has some sort of residual right to Unit 3. Now, getting those leases off the title is a relatively straightforward and quick process, provided the lease has genuinely ended. So it's sensible to clean up the title by removing leases like that before the sale, if at all possible. I'll turn now to some of the issues in the sale contract that can be preempted beforehand with some good preparation. And the aspect that most often entangles the legals is the complexity of how to treat service charge on completion, obviously on a multi-let as opposed to a single-let investment property. The service charge account is an ever-changing animal, particularly with a complex multi-let estate with income coming in from tenants and outgoings paid out all the time. And the difficulty is, how do you pin down a fair and accurate handover from seller to buyer of what's in the service charge pot in that one snapshot of time that is completion of the sale? Now, it's perfectly usual for the investment sale contract to provide for only an estimate of what's in the service charge pot to be paid over to the buyer on completion, or for nothing in relation to service charge to be paid over to the buyer on completion at all, leaving the buyer an amount of time to prepare final service charge accounts, showing the final service charge income and expenditure incurred during its ownership, giving the seller no more than 3 months to do that. And the contract would then provide at the end of that 3-month period what was in the service charge pot, if anything, should be handed over to the buyer. Now, I'd encourage sellers to do 3 things before the legals begin to make the service charge procedure as easy as possible. Firstly, put together a package of full and accurate service charge accounts for the current service charge year and at least the previous 3 service charge years, showing all itemized tenant payments into the service charge pot and all payments for services out of the pot. Secondly, try and finalise and reconcile with the tenants all year-end service charges for all service charge years prior to the current one, if not done previously, so that the buyer only has to worry about the current service charge year. And thirdly, I'd encourage the seller to have an open book policy with the buyer and his accountant from the date terms are agreed. Get the buyer's accountant in there from day one, not just from completion, looking at the service charge accounts, inspecting receipts, checking that voids are dealt with properly, assessing whether the parties can come to an arrangement at completion or shortly after completion, whereby the seller can walk away from the service charge with a clean break and the buyer can start operating the service charge with a clean slate. With a multi-let investment, there will be existing service contracts such as cleaning contracts or contracts for the supply and maintenance of security alarms. For example, these should be disclosed by the seller with the initial package to enable the buyer to identify which contracts it would like to take over. And the seller should have them all ready for inspection from agreement on the heads of terms at the very latest, so that the buyer can decide what he wants to do with those. Whilst the benefit of the service contracts can be assigned from a seller to a buyer without the contractor's consent, at law, the burden of the contract, the seller's obligation to pay the contractor, cannot be transferred unless the contractor consents. So the parties will need to get the contractor involved, which will be impracticable in a 3-week timescale. And you probably don't want to be letting contractors know about an intended investment sale beforehand. The neatest way of passing a security contract from the seller to the buyer is by way of a novation of the contract, which will be a tripartite document involving the contractor, whereby the buyer steps into the shoes of the seller and the seller is released. Failing that, the security contract could be assigned by the seller to the buyer, but remember that will require the contractor's consent to pass the burden of the contract effectively. If the contractor's consent can't be obtained, it may be easiest for the seller to terminate the service contract and for the buyer to start afresh with a new contractor. And the property sale agreement should cater for timescales after completion within which this whole process should be dealt with. But to cut down the debate during the legal process, those service contracts should be ready for review by the buyer from agreement on the heads of terms. Employees who are employed to work at the property may have rights under the TUPE regulations, the purpose of which is to protect the jobs and terms and conditions of employment of employees where the undertaking in which they are employed is transferred. So TUPE applies to any transaction that is considered to be the transfer of an economic entity, and it will include the transfer of property if the property and the employees employed at that property together constitute a business. That might happen on a sale of an investment property such as a shopping centre or office buildings where centre managers, cleaners, security guards, for example, work solely at the property. TUPE is important because all employees employed in the undertaking automatically transfer to the buyer on their existing terms and conditions, and their employment is treated as being continuous for the purposes of claims for redundancy or unfair dismissal. If an employee is dismissed as a result solely of a TUPE change, that dismissal is likely to be automatically an unfair dismissal. So under TUPE, the buyer takes on all rights, liabilities, and responsibilities for anything done by the seller in respect of the employee, and may therefore inherit liability for unfair dismissals and any failure to pay wages or bonuses or other entitlements which arose before the time of the transfer. From a practical point of view, the buyer needs to carry out detailed due diligence against the employees working at the property to establish whether those employees will transfer under TUPE, and if they do, what the terms of their employment are and what potential liabilities the buyer will be inheriting. As with the service charge, because this area has potential for contention, it would help to smooth through the legals if the seller had a package of all the relevant employment contracts by agreement on heads of terms at the latest, and a report on any claims or issues under those contracts so that any employee issues can be weeded out from day one. So those are the main actions I would recommend you taking, and the contract provisions I would recommend you considering to accelerate the legal process from a seller's perspective. You should also give some thought as to how you treat ongoing rent reviews, any rent arrears, and insurance in the contract. My colleague Anna Power will touch on some of those in her talk about facilitating the process from the buyer's point of view. So I'll now hand you over to Anna.
Good morning, everyone. Thank you very much, David. Just bear with me whilst I share my screen. So for those of you that don't know me, my name is Anna Power. I'm a senior associate in the commercial real estate team. I joined Wright Hassall at the end of last year. When acting for a purchaser, timing is everything. As David said, heads of terms probably refer to an exchange of contracts within 3 weeks of receipt of a full sales pack. Now, assuming that the seller has done all of the things that David has talked about, as buyer, you're in the best position to facilitate a swift exchange and completion. However, sometimes getting a complete sales pack can take a bit of time. There are some things that you can do to get ahead. There's a lot to do, so it's imperative to prioritise and spot issues as soon as possible. Before getting stuck into the detail, I always check the following things. Do the heads of terms reflect the deal that the client has done? I do a quick review of the registered title. Is the proprietor the seller on the heads of terms? Is the property charged? And are there any other restrictions requiring third-party consents? I send a copy of the title plan to our client to check the boundaries of the property. For the sake of a few pounds, I often order copies of the title instead of waiting to receive them from the seller. As soon as we have copies of the occupational leases or tenancy schedule, check that the tenant and the contractual term of the leases are as expected. Is the buyer expecting to pay VAT? Jennie will deal with VAT and transfers of a going concern later. However, it is worth noting that if VAT is payable, it will have an impact on the SDLT liability. If the buyer is expecting to get capital allowances, then we'll need to liaise with their accountants early on. Has a surveyor been instructed? And find out when the property was constructed. If it was constructed in the last 12 years, we will need to establish if any collateral warranties are available. We may require input from our construction and planning colleagues, so it's important to give them the heads up and agree any additional fees. Moving on to look at the due diligence. On an investment purchase, it's all about yields, so maximising income and limiting outgoings. Timings-wise, it's important to request searches as soon as possible, as local searches can take around 3 weeks or longer, as David has said. That is, unless you are going to rely on the searches provided by the seller and search insurance. I also request copies of any planning documents that the seller holds as soon as possible, so that we can start to understand the planning title whilst we are waiting for the search result. We obviously need to review the title carefully to check for any rights and covenants that affect the property and any restrictions that require third-party consent to register the transfer. However, reviewing and reporting on the occupational leases is by far the most important part of the exercise to highlight any shortfalls. I suggest that the majority of the 3 weeks is spent reviewing and reporting on the leases, as these will have the most impact on yields, rather than getting bogged down in the contract or transfer. From an investor's point of view, the most important things to review are the term of the lease, the contractual term, and whether it is contracted out. The rent, is it what the client is expecting? Are there any rent-free periods? These may be initial rent-frees or later following a review or break date. What is the rent review mechanism? Is it upwards or downwards, based on open market or RPI, and are there any caps or collars? Is there any service charge shortfall? This is important because on a multi-let property, the buyer will want to ensure that they can get full recovery. Do any of the leases have a cap? Do the provisions of the leases differ, meaning that the landlord cannot recover some of the costs? Can the buyer recover 100% of the insurance premium from all of the tenants? Is the lease a full repairing lease, i.e. good and substantial repair and condition? If not, the buyer could be out of pocket at the end of the lease. Are there any schedules of condition that limit the repair obligation? Are there any break clauses in the leases, and what are the conditions? Alienation. What are the provisions for assignment? In what circumstances can the landlord withhold consent, and is an authorised guarantee agreement required? This is particularly important if you are relying on the covenant strength of one main tenant. We can then move on to look at the replies to CPSEs and search results and report on anything that is unusual or unexpected. We'll also review the planning title. As I say, it's a good idea to ask the seller early on for copies of any planning permissions authorising construction, use and any alterations, because the local search can take time to come through. And then finally, if the property was constructed in the last 12 years, we will need to review any collateral warranties and building contract appointments, etc. If there was an agreement for lease, it's important to check that any developer obligations were personal and will not carry over. When it comes to advising and reporting, all our clients are different. For existing clients, we know how they like things to be done, but for new clients, it's important to understand what information they want, when and how. Normally, I share documents as they come in from the seller or search providers. This is because it enables the client to review the documents simultaneously with me and relieves the burden at the end when we produce our report on title. Where the property is multi-let, it might be appropriate to have a shorter report on the leases, only on the substantive terms. This can sometimes be done in table form. Where there are a number of leases in a similar form, we can report on one in full and then only on differences in the others. Data rooms can be particularly helpful if there are a lot of large documents. It keeps everything in one place and allows easy access for all. Once we've broken the back of the due diligence, we can turn to the contract and transfer. The contract is not normally a contentious document and usually fairly easy to negotiate. However, there are a number of important issues to deal with. Can exchange and completion be simultaneous? This is often preferred by clients and can simplify the contract. Apportionments of rent for any rent paid in advance of the completion date and is usually a deduction from the purchase price in the completion statement. Rent arrears. As a buyer, ideally you don't want to buy the arrears, but you will need to agree who is going to collect them. It is usually best for the buyer to do this, as they will be in control and allowing the seller to do so can be risky. You'll also need to agree who will deal with outstanding rent reviews. If they are relatively recent, then again, it's probably best for the buyer to do this. Service charge. On multi-let properties, there will be a pot of money for the service charge, but as David said, this is an ever-changing amount. If there is an excess, the seller will pay the excess to the buyer on completion. However, any shortfall is unlikely to be recovered until the end of the service charge year. As David said, often the contract provides for an estimate and the parties agree to allow a period of up to 3 months for the seller to finalise the service charge accounts. Insurance. Normally the buyer will put a new policy in place upon completion. The seller should cancel its policy and refund the premium for the period after completion to the buyer or the tenants. If there's going to be a period between exchange and completion, then the contract will need to deal with that too. If there are any service contracts to be carried over, Ideally, they should be novated, as you can't assign the burden of the contract. The sale contract might provide that if a novation cannot be agreed within a certain time after completion, the seller is to cancel its contract and the buyer enter into a new one. If there's going to be a delay between exchange and completion, you will want to ensure that the seller is obliged to manage the property properly so as not to prejudice the investment. And finally, the provisions relating to VAT, transfers of going concern and capital allowances. I'll now hand over to my colleague Jennie Newton, who will look at the tax issues in more detail. Thank you.
Thanks, Anna, and hi everyone. I'm going to look at some of the potential tax pitfalls on a property investment sale and what you can do to avoid or resolve them. But in general, my message is sellers, line up all of your tax requirements well in advance of the sale, so you've got all your registrations and your paperwork to hand really before the sale is even agreed. And to buyers, similarly, I would say address all the requirements you're going to need to meet, plus the data that you're going to need from the seller. Identify that well before the sale so that you're ready to ask for it if it doesn't appear in that pack that comes through. So I'm going to share my screen and just walk you through some slides on the tax. And right, I'm going to look at some of the VAT and capital allowance pitfall, but what I'm going to say now is based on the scenario that's set out in this slide. I'm not going to run through this slide in detail because the slides are available after. So you'll be able to kind of look at this at your leisure after this webinar and digest it. But that's the sort of basis on which I'm speaking today. So just moving straight on to VAT. Now, clearly the parties are going to expect and want the transaction to qualify as a transfer going concern, and that's outside the scope of VAT. As Anna said, TOGCs also carry an SDLT benefit, and that's because SDLT is payable on the VAT inclusive consideration. So clearly, if you've got a TOGC without, the purchase price doesn't bear VAT, and therefore the SDLT doesn't have to be paid on the VAT element. And that can make quite a difference actually on a sale of a property for say £1 million. If it was a TOGC, then the SDLT might be around £10,000 less than if it wasn't a TOGC and VAT was payable. TOGC requirements are mandatory. If they're all met, then TOGC treatment is mandatory. It's worth being aware of that. So this is where transactions really can start to go wrong if the TOGC requirements aren't met. And to recap, I'm not going to focus on these, but you have a slide there just running through the main requirements for a transaction to be a TOGC, and you can look at those after this webinar at your leisure and have a think about those. So I just wanted to run through now some common VAT problem areas that we quite often come across, where there is a problem with the TOGC. So the first one, what happens if the seller just doesn't know if it's made a VAT option? This is it's less common actually than you think. I did come across this quite recently on a transaction. And at this point, this is the time to go through those old financial records, files in storage, ask your current accountants and solicitors, ask your former accountants and solicitors. And there is also the option to check with HMRC's specialist VAT options tax unit in Glasgow. And in the recent matter that we had on for a client, where he had VAT opted a long time ago with some previous accountants had actually affected that for him. He'd forgotten all about it. He'd changed accountants. He wrote off to the VAT options tax unit in Glasgow, and they were able to produce a copy of his VAT option from their files and save the day for him. So that was really good. And they were fairly prompt about coming back as well after he contacted them and explained the rush. So that's what to do if the seller doesn't know if it's made a VAT option. What if the seller hasn't notified a formal VAT option, but it's been charging VAT on rents to tenants since, the year back in the day? This, again, is quite common. It's not possible to backdate a VAT option, but there is a procedure called belated notification. And if it's clear that the seller did decide that it wanted to charge VAT back in the day when it acquired the property, it can ask HMRC to accept the belated VAT option notification. This is effectively the seller saying to the revenue, look, when I bought the property, I did intend to charge VAT, and look, I've been charging VAT to my tenant all, since I acquired this property, but I forgot to notify you, and I should have notified you within 30 days of making the decision to VAT opt, but I didn't notify you. That was my error. Please would you now accept my belated notification of the fact that I did decide to make a VAT option all those years ago. And HMRC will accept that request to accept the belated VAT option notification, provided that the seller can provide evidence that it did decide to make a VAT option back in the day. What if the seller's VAT option is defective in some way? This can also, I think, be dealt with by the belated VAT option notification procedure. So, for example, you might find a situation where the VAT option doesn't cover the whole of the land and buildings owned by the seller, and then it's possible to use that belated notification route, I think. What if the buyer isn't VAT registered and it needs to be? So in the slide on TOGC requirements, you'll see that there's a requirement that if the seller's VAT registered, then the buyer should also be VAT registered or subject to compulsory VAT registration. So there's two routes here. One is buyer goes off and gets itself accepted under the voluntary VAT registration procedure. Now that takes time. At the moment, the revenue is quoting on its website 30 days, but not just 30 days, it's 30 working days. That's 6 weeks. Anecdotally, we understand that if some of the housekeeping requirements for the buyer haven't been met, then the HMRC could take longer and raise queries about that application for VAT registration. The one that seems to be quite material for the revenue is if the buyer hasn't actually, maybe it's an SPV, and it hasn't yet got a bank account open. If there's no bank account open, then the revenue might take a little bit longer, might raise queries. So if buyers are using an SPV, please deal with all that housekeeping, compliance and general setup issues in advance. Another route that you can use to save the day here is the fact that on a TOGC, a buyer sort of inherits the seller's taxable turnover when looking at whether it's required to be VAT registered under the compulsory registration stuff. So if in the last 12 months, the seller's rental income from that property exceeds the current VAT registration threshold, and at the moment this year that is £85,000, then actually the buyer is subject to compulsory VAT registration. That can be really useful when you're ticking off that box about the seller's VAT registered. So is the buyer accepted for VAT registration or subject to compulsory VAT registration? What if the buyer hasn't VAT opted? Well, this should not be a blocker because it is very, very easy to make a VAT option and to notify it. You do it online, there's a form, you fill it in, it's not a particularly difficult form, and you fill it in online, print it off, sign it, date it, scan it back in and email it off to the specialist VAT options tax unit in Glasgow. All of the information is provided online and it should take no longer really, if you're putting your mind to it, than an hour, I think, if that. So that should be pretty easy to deal with. And what people don't often appreciate, and this is a common question, is do you need HMRC's acknowledgement for that VAT option to be effective? And the answer is no, you don't. It's effective from the day that you submit the email to HMRC, as long as the email goes through okay. HMRC will acknowledge it in due course. If you go by email, you'll get a sort of an automatic email back, but in due course, you'll get a letter saying, thanks very much, we acknowledge receipt of your VAT option notification, and it'll summarise the details that you provided. But you don't need that. The VAT option goes live as soon as you've pressed send on that email. And finally, what if the property is a capital goods scheme asset? Now, I'm assuming here that you know what the capital goods scheme is and you're comfortable with that phrase. If you don't, pop a question in the Q&A and I'll deal very briefly with what the capital goods scheme is at the end. But if the property is a capital goods scheme asset, then the buyer on a TOGC, the buyer again inherits the seller's capital goods scheme position. And for that reason, the buyer obviously needs to know what that position is, and we'll be expecting details of that to come through in the replies to CPSEs. Just moving on to capital allowances. Capital allowances obviously can be very valuable. capital allowances on fixtures in commercial buildings can deliver corporation tax benefits to the person claiming them. And the relevance really to capital allowances on commercial buildings is fixtures. So allowances can be claimed for expenditure on certain plant and machinery fixtures. We would always, I think David mentioned this at the beginning, we would always recommend getting a good capital allowances advisor on board to advise sellers and buyers. And we know some very good ones. And if a business doesn't already have a capital allowance advisor on board, we can certainly put people in touch with them. Common capital allowance problems. I think Bill's might speak to this as well, but if you've got a seller who is a non-taxpayer, so a charity or pension fund or local authority, none of those entities in general pay direct tax, so income tax, corporation tax, then they won't have claimed capital allowances. So they won't have been the last person in the building, the last owner, to claim plant and machinery allowances, PMAs. That can potentially restrict the allowances that the buyer can claim. So I suppose the message here is, if you have a seller who is a non-taxpayer, be alert to the fact that the capital allowance position could be quite complicated. In your 3 weeks as a buyer, is this worth pursuing? Ask your capital allowance advisor, to do a desktop capital allowance review, maybe to work out if the capital allowances here are particularly valuable and you really, really want to chase this down. There is a way of the buyer accessing capital allowances in this kind of situation, but it does need to get the seller to provide quite a lot of data. So where the seller's a non-taxpayer, to claim the allowances, the buyer's going to need a written statement by the former owner, the last owner to claim plant machinery allowances, of the amount that it effectively brought into account when it sold the property, the amount that it brought in, its disposal value for fixtures essentially, and also a special written statement by the person who bought from that former owner. And note, that might not be your seller, because there might have been another seller previously who was that person, that you need a special written statement from that person as well. So that can all be quite difficult to line up. You've only got 3 weeks. You're looking at former owners back in the ownership chain. That can be quite difficult. So capital allowance advice is key. Section 198 elections. Non-tax paying sellers can't enter into a Section 198 election when they're selling. And finally, what if the seller hasn't pooled? A buyer's claim on fixtures will be reduced to nil unless the seller has pooled. But if the seller hasn't pooled, all is not lost, because it is still possible for the seller to pool at the point, just before the sale or sort of immediately after the sale. This is going to require the agreement of the parties. So again, that's something to be negotiated between the parties. So that concludes my section of the talk. I've just left our contact details for the Wright Hassall people on the slide there. But I'd like to hand over now to Bill Wareing, who's going to give us the surveyor's perspective, plus some practical hints and tips on transactions.
Right, thank you, Jenny. Yes, and as she said, looking at this from a surveyor's point of view, in respect of either single investment or portfolio sales. I'll give a brief introduction as to who we are, and I will just do an up-to-date market summary of the commercial and investment property markets in Leamington and Warwick, and then I'll deal with issues that should be considered before sale, with advice regarding negotiations during the period of sale. And I'll end up with some final words of wisdom given to me by an ex-partner of Lock in England, who I joined as a graduate surveyor in 1982. Words of wisdom I've never forgotten. I won't be sharing my screen as I've got no slides. So Wareing Company, we're an independent firm of chartered surveyors based in the centre of Leamington. We've been established for 20 years. Prior to that, I was a partner of a national practice. We handle all sectors of commercial and industrial property, and we deal with such assets as Royal Prior Shopping Centre, where we're letting agents, Regent Court, the restaurant quarter, where we're asset managers and letting agents, and which I've sold 3 times since 2006, and then Talisman Shopping Centre in Kenilworth, where we delivered Waitrose a few years ago. And we also act as development agents on Tournament Fields Business Park in Warwick, where we've currently got 3 buildings on site, each of around 20 to 30,000 square feet. I also deal with other landlord and tenant matters and investment transactions. So in terms of market summary, I think it's obviously interesting times at the moment. I'll deal with the various sectors, and I just want to say that I wouldn't like any of these views to be held against me if I got any negotiations ongoing with anyone viewing. First of all, industrial warehousing, this sector is absolutely flying at the moment. Big warehouses are very much in demand, and we're seeing record land prices paid for development sites and ridiculously low yields for investments. Certain investment funds are even forward buying vacant buildings under construction in portfolios just to get a share of the market. And the reason for this is twofold. First, obviously the rise of internet shopping and the demand for warehousing generally, particularly from Amazon. And secondly, it's the sheer weight of institutional money that's trying to find a home in property and who are unwilling to invest in the retail or leisure sectors, or even to a certain extent in the office sector. We've seen about a 25% increase in industrial and warehouse rental values in the past 2 years, and that rolls through to freehold vacant possession values. I personally think that the investment yields are unsustainably low, and particularly as we're potentially going to have inflation coming through. If you do own one of these assets, industrial or warehouse, now would be a very good time to sell. We're seeing that even 40-year-old stock at Sydenham Industrial Estate and Heathcote is selling virtually what a brand new building would now cost, and that's really lack of supply. Offices, I mean, that market died in the spring of last year. Why would anyone take an office when they can't even occupy them? So nothing much has happened in the last 15 months, other than people who had lease expiries or break clauses. But we are now seeing a resurgence of inquiries, but fairly confused ones, because companies don't know how many staff are going to return to work, and therefore are very vague as to exactly how much space they need. So deals that we saw fall through last March are now being replaced, and they're being replaced at proper rents as well. So we've not really seen rents coming off from where they were at the beginning of last year. Personally, I think that all this working from home has been overplayed. We're going to see a change to office fit-outs where there will be specific Teams and Zoom rooms made, but I'm anticipating pretty much a return to office working as before. Leisure market, this is okay. We re-geared a lot of restaurant leases in the centre of Leamington to facilitate rent freeze and reduce rents. And even with reduced capacity, we're seeing traders doing well. And the main issue that they've got is the lack of available staff, and that's been well publicised. And the rents have moved back from where they were at the top of the market in about 2016, but there's still strong demand for particularly fitted units. We had a bidding competition for the old Ask Pizza restaurant on Clarendon Avenue. Boston Tea Party are just about to fit that out, and I think they'll do very well. I've got the Café Rouge in Regent Street under offer, and also the former Gusto unit in Regent Court under offer. So it is good news, and I think certainly a lot of the operators are looking forward to really strong times for the next year or 18 months. Retail, now that is a completely different story. And again, I don't want to be quoted on this if I'm doing a landlord's rent review on retail, but that sector's gone through seismic changes, and we're going to see complete repurposing town centre retail space in shopping centres and changes to high street frontages. I'll mention the changes in the use classes order, but that's going to bring a more variety of retail uses and other uses into town centres. And that doesn't just mean even more coffee shops. As far as investments generally are concerned, there's still an awful lot of money trying to find a home in property. And the key is to get a serious length of commitment from a tenant, make sure the tenant covenant is strong, and look at the quality of the property, particularly regarding environmental issues. And in terms of issues to consider before sale, as I mentioned, timing, I've been amazed about how much activity there's been in lockdown. And if you're thinking of selling and going into cash, and a lot of people aren't at the moment, it might be best just to wait until we are fully out of lockdown. Things can really return to normal. And particularly, I was hopeful that the restriction on forfeiture of leases would come off as was intended, but that's now been extended to next year. And I think that is something that needs to be resolved. In terms of selling, you need to choose the right agent, and you need to have an agent that's got knowledge of the particular sector that you're owning in, and particularly availability of comparable evidence to prove any reversionary income. As I mentioned, length of lease and the rental commitment is key. So it's very wise to re-gear leases if possible, to give rent free in order to add length of lease and enhance capital value. The issue that we've got with that at the moment is that because of the plethora of CVAs and pre-pack deals that have been done, it is very, very difficult to judge the strength of any national covenant at the moment. So you can look a bit of a Charlie if you give significant rent-free to a company who then goes into a CVA or pre-pack, and you've basically given away money for nothing. I think there's going to be a move back for investors looking at local, more owner-managed businesses and feeling more confident with them than relying on smart accountants in London trying to get rid of debt through CVAs. Similarly to the re-gearing, looking to remove tenant break clauses in leases, again subject to covenant, that will enhance value, and it could be worth giving rent-free to enhance in order to enhance the capital value of the asset. I mentioned the use classes order, changed last year to facilitate Class E use, and now that incorporates retail, restaurants and offices, changing without a need for planning consent. I think before you're considering a sale, it might be worth looking at the user clauses within leases, seeing what's permitted, and if possible, seeing whether it would be possible to widen the use clause with the tenant's agreement to give them more flexibility on assignment, but that could also enhance future rental value. Regarding the sale, David and Anna have covered most areas. Obviously, to get things lined up right before you go to the market. And as we're seeing with substantial investment sales, often there are data rooms available now with all the information that you ever possibly need. That's obviously something that happens with auctions. And when David asked me to talk on how to achieve a sale within 3 weeks, I thought, well, that's easy. Just stick it into an auction with a 3-week completion, job's done. How are we going to talk for an hour on that? What I would say, however, and I haven't got experience of the regional auction houses, but I have of the London auction houses, and they are useful if you've got a particular assets that got issues. But my concern is that, and I'm not sort of saying that there are potentially rings within certain auction houses, but I've had experience where you do see that auctioneers do have favourite purchasers, and you do see that certain groups will not bid against each other. I've always really thought to my clients that it's a last resort situation going to a London auction. I think you can get better returns by controlling the transaction by a private treaty sale. Obviously, Jennie and Anna mentioned capital allowances. That's something we're seeing more and more. And it can be very embarrassing if you haven't covered that when you've agreed a sale and a vendor suddenly realises that a purchaser is expecting to claim capital allowances that they could have claimed. And that can potentially completely kill a deal. EPCs, they're getting more important, and they will continue to be more important because of the way compliance is going. You need to get as good an EPC as possible, and surprise, surprise, not all assessors are the same. Some that we've had experience of are slightly more gentle than others, so it's very important to get an EPC assessor who's comfortable with the property that they're assessing to give you the best result. As has been said before, don't rely on local authorities and county councils in particular to respond to inquiries when you've agreed a sale. They're under-resourced, and you need to get these things, particularly highways issues, sorted sooner rather than later. Important to have the best professional team, and obviously Wright Hassall, an undoubted firm of lawyers. But one thing I would say, and with respect to my co-presenters, is that a lot of lawyers think that they're property agents. And many times I've agreed deals, and then you see a lawyer trying to renegotiate them right from the start. They won't thank me for saying this, but lawyers are there to document transactions that have already been negotiated in the market. They're very useful to play games in terms of inventing issues if you want to delay acquisitions. But when deals are agreed, most parties just want the solicitors to document it. Similarly, that is the case for accountants, who, in my experience, many think they're valuers and they're just not. Right, in terms of identifying a purchaser, it's essential that you've got to have confidence in that purchaser. You've got to make sure the money is not dirty, they're going to perform. Now, what we're experiencing is that in the lower price sector, particularly up to sort of about £1 million, we're seeing more and more amateurs getting involved. And frankly, that can just waste an awful lot of time. Not appreciating what is involved in buying a property investment, So my advice to any vendors is you pick a purchaser right from the start who is properly advised at the start of the deal. The other thing I think is key is that you've got to be prepared to walk away if you sniff any chip coming in any transaction. I had a recent investment deal lined up, period property on the parade, centre of Leamington, London city lawyer acting for the purchaser. We agreed the deal. Then you could just see one thing after another coming to try and chip a price, including basements and going under the adopted highway. All parade properties have that. That was going to be a liability we want to chip. When we said no, the space under the adopted highway wasn't included in the freehold title or the lease. We want to chip. Can't have it both ways, chap. So you've got to stand up against just spurious reasons why people are trying to get a price reduction. And that includes things like interim schedules of dilapidations, which frankly are pretty meaningless. You can't use those as something to try and get a chip. I think that's really all I've got to say. I'm happy to take questions, but the words of truth that were given to me on July the 12th, 1982, when I started at Lock in England, a fresh-faced graduate from Birmingham Poly, were from Geoffrey Verica, who some of you might remember, partner in charge of the management department of Lock in England. He was definitely not woke, and it shows how things have changed. At the end of my first day, he called me into the office and he said, Wareing, if you remember something from me throughout your career, remember this. All tenants are liars and all caretakers are drunks. Yeah, never forgotten that. Thank you very much.
Just one follow-up sort of question that relates to a point that a couple of us have been making, which is about my idea that it would be good practice for the seller to obtain a package of search results before the transaction to speed things along, given the slowness of local authorities, which I think three of us have mentioned. Anna and I were debating yesterday, what would a buyer's ability be to be able to rely on the package of searches in circumstances where the searches had been obtained by and for the seller? Well, the answer to that is the buyer can rely on the local search result. So the local search result covers liability in negligence for the person who raised the inquiries, the person on behalf of whom the local inquiries were raised, and any other person who has knowledge personally or through an agent of the replies before the time of purchase. So the local search does confer liability on the buyer and on the seller as well. With the other searches, the drainage search, the environmental search, etc., it does depend on the terms and conditions of the search provider. Now, you might be able to get a letter of reliance from the search provider if you're a buyer wanting to rely on the seller's other package of searches. Another quick and straightforward means of getting an ability to rely is to obtain a search validation insurance policy. So insurers will have a set of searches and they will give you as buyer insurance cover on payment of a one-off premium to enable you to rely on those searches that weren't addressed to you originally. And the premium amount would depend on the amount of the purchase price and the amount that you're seeking to cover. But we're not talking extortionate sums. We'd certainly be talking a three-figure sum rather than a four-figure sum for a one-off premium on a 1 million property purchase, for example, and probably considerably less, probably something under 500 quid. So the providing of searches by the seller is I think a tactic to be encouraged on both auction sales and on private investment sales as well. Thank you very much for listening to us all today, everybody. I'd like to thank Bill and my colleagues at Wright Hassall for their talks today. Very much appreciate you joining us. As I say, a recording of this webinar will be on our website shortly, but pleasure to have you joining us, and do have a nice day, everybody. Thank you.